or decades, silver has occupied an awkward position inside institutional portfolios, discussed quietly as a hedge but rarely treated as a core asset. And that tension has never fully resolved, even as market behavior begins to suggest something is shifting beneath the surface. At the policy level, precious metals are still framed as relics of a prior monetary era, yet funding flows and positioning tell a more complicated story, one that doesn't surface in official statements and becomes visible only when stress appears elsewhere in the system. Historically, silver's role has been defined by contradiction, serving simultaneously as money, industrial input, and speculative instrument, and each cycle forces markets to confront which identity dominates, a question that remains unsettled heading into the current environment. In recent years, price action has been less about enthusiasm and more about suppression through indifference, with volatility compressed and participation thinning, a setup that seasoned investors recognize as unstable rather than benign. Among veteran market observers, Marc Faber has long approached such conditions with caution rather than optimism, not because he dismisses upside potential, but because he watches how systemic pressures accumulate before narratives catch up. Faber's perspective has never centered on price targets in isolation, but on imbalances, especially those created when monetary expansion collides with real-world constraints, a collision that silver is uniquely exposed to. When liquidity floods financial assets, it doesn't immediately lift all boats, and silver often lags, not due to weakness, but because it sits outside the primary channels of speculation, waiting for credibility to crack elsewhere. That delay has historically created mispricings, but only when the broader system becomes fragile enough that hedging shifts from optional to necessary, a transition markets rarely recognize until it's underway. In the current cycle, monetary credibility is being tested less through inflation headlines and more through confidence erosion, where policy responses grow larger while their marginal impact shrinks, a dynamic Faber has flagged repeatedly. Silver's sensitivity to that erosion lies in its dual nature, responding not just to currency debasement, but also to industrial demand cycles that don't follow central bank timelines. As industrial usage expands quietly, especially in energy and electronics, inventories tighten incrementally, not dramatically, creating pressure that doesn't register until it becomes difficult to relieve. This structural tightening rarely produces headlines, but it alters risk asymmetry, where downside becomes limited by physical demand, while upside remains capped only by sentiment, a condition that doesn't persist indefinitely. In prior periods, silver broke out not when fear peaked, but when confidence quietly failed, leaving investors scrambling for assets that weren't promises or derivatives, a pattern that may be closer than it appears. Faber's caution toward paper assets has always been rooted in historical memory, particularly how markets behave when leverage meets uncertainty, and silver has repeatedly served as a release valve during those moments. Yet the idea of silver reaching levels once considered extreme, such as $100, isn't something he frames as inevitable or imminent, but as conditional, dependent on systemic responses that haven't fully played out. Those conditions include fiscal behavior, currency coordination, and public tolerance for financial repression, all of which remain unresolved and increasingly strained. What makes silver particularly dangerous to ignore is not its past volatility, but how little capital it would take to reprice it if confidence fractures, a reality institutions understand but rarely articulate. Positioning data suggests that silver remains underowned relative to its risk profile, not because investors doubt its function, but because timing such inflections carries reputational risk. That reluctance often persists until price moves force acknowledgement, at which point re-entry becomes reactive rather than strategic, amplifying volatility rather than containing it. The question, then, isn't whether $100 silver is possible in theory, but what chain of events would make such a level plausible without triggering earlier intervention or substitution? Faber's lens suggests that by the time such numbers enter mainstream discussion, the underlying drivers are already entrenched, leaving little room for orderly adjustment. And if that's the case, the more revealing signal may not be silver's price itself, but what its movement would imply about the broader system that allowed it to happen, a realization markets aren't prepared to confront yet. Behind closed doors, discussions around monetary stability are less confident than public messaging suggests, and that divergence has historically been where assets like silver begin to matter again, not as trades, but as indicators. Within central banking circles, silver is rarely mentioned directly, yet its price behavior is quietly monitored as a proxy for confidence in currency durability, particularly when gold alone no longer captures the full picture. The reason is structural, not speculative, because silver's market is thin enough that shifts in marginal demand can reveal stress points faster than larger, more liquid assets. When fiscal expansion accelerates, as it has across developed economies, policymakers rely on predictable transmission mechanisms, but silver often reacts outside those channels, exposing blind spots. Faber has repeatedly emphasized that the danger isn't inflation itself, but the loss of control narratives around it when official explanations no longer align with lived economic experience. In such environments, investors don't rush immediately into metals, they hesitate, test alternatives, and only pivot when traditional hedges fail to perform as expected. That hesitation creates a lag, during which silver remains subdued despite mounting pressures, reinforcing the perception that it's irrelevant or obsolete. Yet history shows that silver's re-entry into institutional relevance is abrupt, not gradual, driven by sudden reassessments rather than slow accumulation. One factor often overlooked is how derivative positioning suppresses visible price signals, allowing physical market stress to build without reflecting in futures curves. As long as paper supply satisfies short-term demand, price remains contained, but that equilibrium depends on confidence in settlement and liquidity. Once that confidence weakens, even modest physical demand can overwhelm available inventories, forcing repricing that derivatives can't easily offset. Faber has warned that financial engineering works best in stable conditions, but becomes brittle when participants seek delivery rather than exposure. This shift doesn't require mass panic, only a small cohort of capital reallocating with intent, something that's already occurred in prior cycles with outsized impact. Silver's industrial consumption compounds this effect because, unlike gold, much of it is consumed permanently, tightening supply in ways that aren't reversible. As green energy initiatives expand, silver usage increases steadily, not explosively, but enough to erode buffer inventories over time. This slow drain is easy to dismiss until it intersects with financial demand, at which point price dynamics change rapidly. Market participants often assume substitution will cap silver's upside, but in practice, substitution lags price and rarely offsets immediate shortages. Faber's skepticism toward price targets stems from this complexity, where linear projections fail to capture nonlinear responses. A move toward $100 silver wouldn't be the result of enthusiasm or speculation alone, but of constraints revealing themselves simultaneously. Currency debasement, supply friction, and trust erosion don't announce themselves. They converge quietly until repricing becomes unavoidable. At that stage, silver's volatility becomes a feature rather than a flaw, reflecting the market's attempt to reconcile conflicting signals. What's unsettling is that current pricing still assumes a return to normalcy, a belief that past cycles show can persist far longer than justified. And if that assumption breaks, silver's response may not be incremental, raising uncomfortable questions about what other assets are mispriced alongside it. Historically, markets don't reprice assets like silver in isolation. They do so when a broader framework fails, and those failures tend to begin at the margins, where attention is lowest and assumptions are strongest. In previous cycles, silver lagged gold until confidence fractures spread beyond currency markets into industrial and credit systems, creating a convergence few anticipated. That convergence matters because silver is uniquely exposed to both sides of the economy, financial and real, making it sensitive to stresses that remain invisible elsewhere. Faber has often pointed out that when policy responses grow larger but less effective, markets begin to question not just outcomes, but competence. This skepticism doesn't surface in volatility indices immediately, but in capital allocation decisions that appear minor until they accumulate. Small reallocations away from long-duration assets and into tangible hedges can shift price dynamics dramatically in thin markets. Silver's relative neglect magnifies this effect, as fewer participants control a larger share of available liquidity. When those participants adjust, the market reacts disproportionately, creating moves that seem irrational to observers relying on traditional models. This is why silver rallies are often dismissed as speculative excess, even when they're driven by structural repositioning. Faber's framework resists that dismissal, focusing instead on what such moves reveal about systemic confidence. He has noted that price spikes in neglected assets often precede broader market acknowledgement, not the other way around. In the current environment, debt sustainability has become a quiet concern, discussed in technical terms but rarely addressed in substance. As servicing costs rise, governments face constraints that policy tools can't easily resolve without credibility loss. Silver becomes relevant here not as a solution, but as a signal, reflecting how markets process those constraints. The idea of $100 silver sounds extreme only within a framework that assumes orderly adjustment. Once that assumption is questioned, historical comparisons shift, and previously unthinkable outcomes enter the realm of possibility. Faber has cautioned that investors tend to anchor to nominal prices without adjusting for currency erosion, distorting perceptions of what constitutes an extreme. Viewed through that lens, higher silver prices may reflect declining currency value rather than rising metal value. This distinction matters because it reframes silver's movement from speculative mania to monetary recalibration. Industrial users, meanwhile, don't respond to macro narratives, but to availability and cost stability. As prices rise, they hedge and secure supply, inadvertently reinforcing upward pressure. This feedback loop is rarely acknowledged until it's well underway. At the same time, mining output faces constraints that aren't easily resolved through price alone. Permitting delays, capital discipline, and declining ore grades limit supply elasticity. These constraints don't guarantee higher prices, but they reduce the market's ability to absorb demand shocks. Faber's analysis consistently emphasizes fragility over forecasting, asking where systems break rather than where prices go. Silver's fragility lies in its market structure, where small imbalances can cascade quickly. If confidence continues to erode across financial systems, silver's response may be less about valuation and more about recalibration. And in that recalibration, numbers once considered hypothetical may become reference points, not targets, forcing a reassessment that few are prepared for. At the institutional level, risk is rarely framed in terms of collapse, but in terms of slippage, where systems continue to function while gradually losing coherence. And silver tends to react to that slippage earlier than most assets. This is because silver doesn't rely on yield, policy support, or earnings narratives, leaving it exposed only to confidence and availability. Faber has argued that such assets are ignored not because they lack merit, but because they don't fit neatly into modern portfolio frameworks. When volatility is suppressed and correlations are stable, silver appears redundant, offering neither growth nor income. But as correlations shift, that redundancy becomes optionality, something investors value only after it's scarce. The transition from redundancy to necessity often occurs during periods of policy contradiction, when central banks promise restraint while fiscal authorities expand. Those contradictions don't resolve quickly, and markets struggle to price them accurately. Silver's role in this environment isn't to outperform immediately, but to remain mispriced until pressure forces recognition. In past cycles, that recognition arrived suddenly, often following events that weren't directly related to metals. Currency realignments, credit stress, or geopolitical disruptions have all served as catalysts without being root causes. Faber's commentary has consistently warned against waiting for confirmation, noting that by the time consensus shifts, pricing has already adjusted. Yet most institutional capital is structurally constrained to wait, bound by mandates and benchmarks. That delay creates asymmetry, where early movers absorb volatility while late movers absorb cost. Silver's smaller market magnifies this dynamic, turning incremental flows into meaningful price moves. The concept of $100 silver becomes less about enthusiasm and more about arithmetic when considering how little capital it would take to force such levels under stress. This isn't a forecast, but an observation about market depth and elasticity. What restrains silver in normal times is not supply abundance, but confidence in substitutes. Once substitutes lose credibility, silver's market clears at higher prices by necessity, not choice. Faber has pointed out that financial repression doesn't eliminate demand for real assets. It delays and concentrates it. When that concentration releases, price moves tend to overshoot equilibrium. Silver's history is full of such overshoots, followed by long periods of consolidation. Those patterns frustrate traders, but reward patience, a dynamic few institutions are equipped to manage. Industrial demand adds another layer of rigidity, as manufacturers can't simply opt out of usage without redesign. As prices rise, they secure supply aggressively, further tightening availability. This behavior isn't speculative, but operational, and it compounds market stress quietly. The risk for policymakers is that silver's repricing sends a signal they can't easily counter without addressing root issues. Unlike equities or bonds, silver can't be stabilized through communication alone. If silver begins to move decisively, it may reflect not a loss of control, but a loss of narrative dominance. And once narratives lose credibility, restoring them becomes far more difficult than maintaining them, a reality that could redefine how markets interpret silver's trajectory. For decades, policy frameworks have relied on the assumption that confidence can be managed indefinitely through communication. Yet silver has a history of responding not to words, but to outcomes, exposing gaps between intent and effect. This distinction matters because markets tolerate inconsistency longer than they tolerate incoherence, and silver tends to react when the latter becomes evident. Faber has often stressed that the most dangerous phase in a cycle isn't crisis, but normalization attempts that fail quietly. When interventions grow routine, their signaling power weakens, leaving markets to search for alternative anchors. Silver's appeal emerges in that search not as a hedge against catastrophe, but against policy fatigue. In such conditions, capital doesn't rush. It reallocates cautiously, testing the system's tolerance for deviation. Those tests often occur in overlooked assets, where resistance is lowest and feedback is fastest. Silver fits that profile precisely, offering exposure without entanglement in complex financial structures. As financial products proliferate, their interdependencies increase, amplifying systemic risk. Silver, by contrast, remains largely outside those webs, which is both its limitation and its strength. Faber's skepticism toward complex hedging strategies reflects this preference for simplicity under uncertainty. He has argued that when systems become too intricate, their failure modes become unpredictable. Silver's simplicity reduces that unpredictability, making it a clearer signal rather than a noisier one. The notion of silver reaching $100 challenges conventional risk models because it implies a breakdown in assumptions rather than a gradual shift. Such breakdowns rarely announce themselves through consensus forecasts. Instead, they surface through anomalies that are dismissed until they're widespread. Silver's volatility is often cited as a reason to avoid it, yet that volatility reflects sensitivity, not instability. In periods of transition, sensitivity becomes valuable, highlighting shifts before they're widely recognized. Faber has noted that markets often misinterpret sensitivity as weakness, underestimating its informational value. As inflation narratives evolve, focus remains on consumer prices, while asset price inflation receives less scrutiny. Silver straddles that divide, reacting to both monetary conditions and real-world demand. This dual response complicates analysis but enhances signal quality. If silver begins to move independently of broader commodity trends, it may indicate a monetary rather than industrial driver. Such divergence would challenge prevailing narratives and force reevaluation. Institutional hesitancy to engage with silver stems partly from its history of sharp reversals. Yet those reversals often follow periods of policy intervention rather than organic market adjustment. When interventions lose effectiveness, reversals give way to repricing. The risk isn't that silver becomes overvalued, but that it remains undervalued until adjustment becomes abrupt. Faber's caution lies in timing, not direction, acknowledging that markets can remain misaligned longer than expected. But once alignment occurs, it tends to happen faster than models predict. If that moment arrives, silver's price may reflect accumulated pressures rather than incremental change, reframing what levels like $100 represent in context. Shall I continue with part 6? For decades, policy frameworks have relied on the assumption that confidence can be managed indefinitely through communication. Yet silver has a history of responding not to words, but to outcomes, exposing gaps between intent and effect. This distinction matters because markets tolerate inconsistency longer than they tolerate incoherence, and silver tends to react when the latter becomes evident. Faber has often stressed that the most dangerous phase in a cycle isn't crisis, but normalization attempts that fail quietly. When interventions grow routine, their signaling power weakens, leaving markets to search for alternative anchors. Silver's appeal emerges in that search, not as a hedge against catastrophe, but against policy fatigue. In such conditions, capital doesn't rush. It reallocates cautiously, testing the system's tolerance for deviation. Those tests often occur in overlooked assets, where resistance is lowest and feedback is fastest. Silver fits that profile precisely, offering exposure without entanglement in complex financial structures. As financial products proliferate, their interdependencies increase, amplifying systemic risk. Silver, by contrast, remains largely outside those webs, which is both its limitation and its strength. Faber's skepticism toward complex hedging strategies reflects this preference for simplicity under uncertainty. He has argued that when systems become too intricate, their failure modes become unpredictable. Silver's simplicity reduces that unpredictability, making it a clearer signal rather than a noisier one. The notion of silver reaching $100 challenges conventional risk models because it implies a breakdown in assumptions rather than a gradual shift. Such breakdowns rarely announce themselves through consensus forecasts. Instead, they surface through anomalies that are dismissed until they're widespread. Silver's volatility is often cited as a reason to avoid it, yet that volatility reflects sensitivity, not instability. In periods of transition, sensitivity becomes valuable, highlighting shifts before they're widely recognized. Faber has noted that markets often misinterpret sensitivity as weakness, underestimating its informational value. As inflation narratives evolve, focus remains on consumer prices, while asset price inflation receives less scrutiny. Silver straddles that divide, reacting to both monetary conditions and real-world demand. This dual response complicates analysis but enhances signal quality. If silver begins to move independently of broader commodity trends, it may indicate a monetary rather than industrial driver. Such divergence would challenge prevailing narratives and force reevaluation. Institutional hesitancy to engage with silver stems partly from its history of sharp reversals. Yet those reversals often follow periods of policy intervention rather than organic market adjustment. When interventions lose effectiveness, reversals give way to repricing. The risk isn't that silver becomes overvalued, but that it remains undervalued until adjustment becomes abrupt. Faber's caution lies in timing, not direction, acknowledging that markets can remain misaligned longer than expected. But once alignment occurs, it tends to happen faster than models predict. If that moment arrives, silver's price may reflect accumulated pressures rather than incremental change, reframing what levels like $100 represent in context. At the institutional level, portfolio construction still assumes that liquidity will always be available at a reasonable cost, an assumption silver quietly challenges when conditions tighten. Silver's market doesn't fail loudly. It thins, spreads widen, and price discovery becomes erratic, signals professionals recognize but rarely discuss publicly. Faber has pointed out that liquidity risk is often mispriced because it doesn't appear on balance sheets until it's already a problem. In calm periods, liquidity is taken for granted, but during stress, it becomes the asset. Silver's physical nature complicates this further, because delivery, storage, and transport introduce frictions that paper markets smooth over until they can't. When those frictions surface, they force repricing not based on models, but on availability. This is where silver diverges sharply from financial assets that can be created or expanded through policy decisions. Faber has consistently warned that assets tied to real-world constraints behave differently when confidence in abstraction erodes. As balance sheets expand and debt rolls over at higher costs, pressure shifts from solvency to credibility. Markets may tolerate debt, but they don't tolerate uncertainty about repayment mechanisms. Silver becomes relevant in that uncertainty, not as a replacement, but as a benchmark against which trust is measured. The idea of $100 silver gains traction only when trust metrics begin to fail. Such failure isn't dramatic at first. It appears in funding markets, collateral preferences, and settlement behavior. These shifts rarely make headlines, but they alter how institutions allocate risk. Silver's small size makes it reactive to these changes long before they affect larger markets. Faber's observations often focus on second-order effects, where actions taken to stabilize one area create pressure elsewhere. As yields are managed and currencies guided, distortions accumulate in places deemed less important. Silver has historically been one of those places absorbing pressure quietly. When that absorption capacity is exhausted, release becomes inevitable. The release isn't orderly because there's no central authority managing silver's valuation. Instead, price adjusts until equilibrium is restored, wherever that may be. This is why historical silver moves appear disconnected from fundamentals when viewed in isolation. In reality, they reflect delayed responses to broader imbalances. Industrial users, financiers, and investors don't coordinate, but their actions converge under stress. That convergence compresses timelines, turning gradual issues into sudden moves. Faber's cautionary stance reflects this compression risk, where waiting for clarity becomes costly. Clarity often arrives only after repricing has occurred. If silver were to approach levels like $100, it would likely be during such a compressed phase, when explanation lags price. By then, the question wouldn't be whether silver is expensive, but why so many other assumptions failed to hold. And that question tends to unsettle markets far beyond the metal itself. Behind closed doors, institutional risk committees tend to focus on probabilities, not possibilities, and silver has long been treated as a low probability consideration, even as its potential impact remains outsized. This bias toward probability causes slow-moving risks to be discounted until they become unavoidable. Faber has often argued that markets misjudge tail risks not because they're rare, but because they're uncomfortable to model. Silver's behavior sits squarely in that discomfort zone where historical precedent exists, but timing defies precision. As global financial systems grow more interconnected, localized stresses propagate faster, reducing the buffer time institutions rely on. Silver's market reflects this acceleration, responding quickly once thresholds are crossed. Those thresholds aren't fixed prices, but confidence markers, where participants reassess assumptions collectively. Once reassessment begins, positioning changes rapidly, overwhelming normal liquidity. Faber's skepticism toward leveraged exposure highlights this vulnerability, as leverage amplifies both gains and failures. In silver, leverage can distort price discovery, but it also accelerates resolution when positions unwind. This dynamic explains why silver moves are often violent rather than smooth. Such moves aren't driven by enthusiasm, but by forced adjustment. The idea of $100 silver becomes plausible only within this forced context, where repricing reflects urgency rather than optimism. Markets rarely pause to justify these moves in real time. Explanations arrive later, often sanitized and incomplete. What matters in the moment is access, not valuation. Silver's physical constraints make access a defining factor under stress. Faber has noted that when access becomes uncertain, price becomes secondary. This inversion of priorities marks a shift from normal market functioning to contingency behavior. Contingency behavior doesn't follow historical averages or fair value models. It follows necessity. As necessity spreads, assets once considered niche gain prominence. Silver's role in this phase isn't glamorous, but it's decisive. It reveals where confidence has failed and where it's being rebuilt. Institutional reluctance to acknowledge this role stems from discomfort with assets that don't generate cash flow. Yet during periods of systemic stress, cash flow matters less than solvency and optionality. Silver offers optionality without dependency, a rare combination. Faber's long-standing caution reflects respect for this independence. He doesn't advocate concentration, but awareness. Awareness that markets can shift regimes without warning. If such a shift occurs, silver's repricing could be swift, compressing years of adjustment into weeks. At that point, debating whether $100 silver makes sense becomes irrelevant. The more pressing question becomes what conditions allowed such a move to happen unchecked, and that question often signals that a deeper transition is already underway. At the institutional level, regime shifts are rarely acknowledged in real time because doing so would require admitting that prior frameworks no longer apply, and silver often exposes that failure before it's formally recognized. Faber has emphasized that markets don't break, they transition, moving from one set of assumptions to another without clear handoffs. During these transitions, pricing becomes less about equilibrium and more about discovery, where participants probe boundaries through action rather than analysis. Silver's thin structure makes it one of the first places where this probing becomes visible. As capital searches for assets outside policy influence, it doesn't move uniformly. It concentrates where impact is immediate. Silver absorbs that concentration rapidly, translating marginal shifts into pronounced moves. This isn't because silver is special, but because it's small, tangible, and difficult to expand quickly. Faber's view has always been that such assets don't signal the future, they signal the present more honestly than others. When silver prices move sharply, they reflect what markets are doing, not what they're saying. That distinction becomes critical when official narratives lag behind behavior. In late cycle environments, narrative control weakens as outcomes diverge from guidance. Silver's repricing in those moments acts less as a warning and more as confirmation. Confirmation that trust is being reassessed across the system. The $100 level, often cited as extreme, functions psychologically as a threshold, not a destination. Thresholds matter because they force engagement, compelling institutions to justify why they ignored earlier signals. By the time such levels are approached, positioning is already defensive. Liquidity is prioritized over optimization and optionality over yield. Silver fits that shift naturally, not by design, but by structure. Faber has cautioned that once markets enter this phase, reversals become policy-dependent rather than organic. Intervention can slow repricing, but it rarely restores prior dynamics fully. What emerges instead is a new baseline, shaped by accumulated adjustments. Silver's role in establishing that baseline is often misunderstood until after the fact. It doesn't lead transitions, but it records them indelibly. If silver were to trade near levels once thought implausible, it would likely be a byproduct of broader recalibration rather than isolated enthusiasm. The metal wouldn't be telling a story about itself, but about the system around it, and that story, once written in price, tends to be difficult to erase. And for decades, discussions about silver have oscillated between neglect and fascination, yet neither captures its true function within the financial system, which is less about return and more about reference. Marc Faber's perspective doesn't hinge on whether silver should or shouldn't reach $100, but on what such a price would quietly confirm about the state of monetary confidence, policy credibility, and systemic resilience. Silver doesn't generate narratives, it reacts to them, absorbing the consequences of decisions made elsewhere. When markets are stable, that reaction is muted and easily dismissed. When stability becomes performative rather than real, silver begins to speak more clearly. A move toward levels once considered extreme would not arrive with consensus approval or clean explanations. It would arrive as a reflection of accumulated distortions resolving simultaneously. In that sense, $100 silver wouldn't represent excess, but exposure, revealing pressures that had been managed, deferred, or ignored. Faber's caution lies in recognizing that markets rarely give advance notice before repricing reality. They adjust first, then rationalize. Silver's value then is not in predicting outcomes, but in indicating when assumptions have failed. If it begins to move decisively, the more important question may not be how high it goes, but what else is being repriced alongside it, because by the time silver commands attention, the system that overlooked it has already begun to change.